Just welcome everyone. Thanks for joining today's webinar. On behalf of the entire Tavola Group team, we're really excited that you took time out of your day to learn more about One Big Beautiful Bill, aka for all the Star Wars fans out there, OB3. Joining me today is James Kelly. He's the Director of Operations here at Tavola Group. He is the resident expert on OB3 and will be able to answer any and all of your questions as we continue to dive into everything. My name is Matt Schumacher, and I am the Director of Tax Planning here at Tavola Group, and I'll be hosting today. This is an interactive session. If you joined us before, you know we love to have questions as we go. So just drop them in the chat function. We'll be answering as we go. If we missed you, don't worry. We'll do a catch-all at the end and make sure we get everything answered. To help us get a sense of where everyone's at in relations to One Big Beautiful Bill, if this is your first time learning about One Big Beautiful Bill or OB3, just in the chat function, type new. And if you've done some research before and you have specific questions that you're hoping to learn today, just about OB3, just type your in the chat, type me. So first time hearing about this, new. If you have some specific questions, type me. All right, while you're doing that, let me just get through a few disclaimers. Tavola Group and its employees do not provide investment, tax, or legal advice, nor do they endorse any specific investment products. All information shared is for educational purpose only. If you're viewing this, we strongly encourage you to consult with your professional, whether it's an attorney, an accountant, a financial advisor, before making any sort of investment or financial decisions. All right, now that we got that taken care of, let's just get through dive into a few things about Tavola. Let's start with who Tavola is and why the name Tavola matters. It actually means, in Italian, it means table, and that's exactly how we see our role, having a seat at your table. Whether you're a real estate investor or a business owner, you've got a lot on your plate. You're likely surrounding yourself with trusted professionals, attorneys, CPAs, advisors. Everyone's offering a specific set of advice or service. We truly believe those people should work together, not isolated in silos. So at Tavola Group, we've designed to be a part of that ecosystem, whether that's pulling up one seat or multiple seats. Our goal is to really collaborate with your existing team to anticipate your needs, reduce your risk, and design custom strategies that help you succeed. But for us, it's not just about numbers on spreadsheets, although James does love a good spreadsheet. We believe wealth should serve a purpose: your family, your legacy, your freedom. That's why our systems are built to make your experience smooth, proactive, and efficient, so you get more time to focus on what truly matters to you. So what is tax planning? Like when we say tax planning, you hear that as a buzzword all the time, but what do we really mean? Because we truly believe it goes far beyond filing your return once a year or just checking the boxes for compliance. True tax planning is proactive. It's all about building a strategy that aligns with your goals, not just reacting to deadlines. The reality is the tax code isn't black and white. It's full of gray areas. And if you spend any time on social media, you see a lot of so-called tax experts out there telling you about tips and tricks. But that's exactly when real expertise matters, is to navigate through all those tips and tricks and see how it works for you in your situation. At Tavola Group, we view tax planning as a partnership. We take time to understand your current facts and circumstances, and then we work with you to craft the path that supports your short and long-term goals in the most tax-efficient way. Our job isn't just to help you reduce your liabilities, but more so to help you preserve your wealth and keep you fully compliant and staying ahead of tax law changes, such as the One Big Beautiful Bill that we'll talk about today. But more importantly, we want to make sure that you're empowered to make good tax efficient decisions for you and your family. So why does all of this matter? Because tax planning helps you do more with what you've earned. It improves your cash flow. It reduces audit risk and gives you better control over long-term goals like retirement or scaling your business or even estate planning. There's a common myth that tax planning only is for ultra wealthy. That's just really simply not true. We work with real estate investors and businesses of all sizes throughout the entire country. Anyone that's making significant financial decisions, you really should be making them with a tax plan in place. So today we're diving into one big beautiful bill. But if you're wondering whether you or your business might be leaving money on the table, we'd love to help you find out. We offer a complimentary tax planning consultation designed to uncover missed deductions, optimize your structure, and develop a strategy for long-term growth. There's no cost, no pressure, just insights from professionals who do this every day. If you're interested, at the end of this, I'll share my contact information and a link to be able to book directly. We encourage you to book a free session, take the first steps towards proactive tax planning. Now, without any further ado, I'm excited to introduce you to my colleague and friend, someone I've really enjoyed getting to know and collaborate with, James Kelly. James is the Director of Operations here at Tavola Group and a proud graduate of San Diego State University, where he earned both his bachelor's degree in accounting and his master's degree in information systems. Outside of work, James is a big baseball fan, especially when it comes for cheering on his beloved LA Dodgers. As a CPA with more than 20 years of experience in accounting, management systems, designs, and analytics, James works closely with clients to transform their existing accounting and business data into clear, actionable intelligence. He also has the rare gift of making even the most complex accounting concepts easy for anyone to understand. And that's exactly why it's a real pleasure to have him here today to help us dive into the one big beautiful bill.
Thanks, Matt.
James?
First, go Aztecs. And I don't want to field any questions on the Dodgers, so let's keep that out of the chat. All right, let's start. We're going to go over what kind of a real 1,000-foot view of what we're going to talk about. There's some major policy shifts slated for 2025. There's a lot of enhanced deductions, expanded incentives, and we're going to concentrate on these specific subjects because strategic timing is critical for optimizing these benefits. Can't wait until the end of the year. I think people's biggest mistake with taxes in general is waiting to talk to a CPA or a preparer after the year has ended. At that point, there's almost nothing that we can do proactively, at least. It's all going to be reactive based on what you've already done throughout the year. So starting early is super important, especially considering that some of the tax provisions have weird end dates, weird start dates, and we'll go through some of those very specific ones once we get to them. All right, so just a general overview of this is that the last major tax bill we had was in 2017. It was a few hundred pages. It was the TJCA, which a lot of the tax stuff we're going to be talking about today expanded on. This bill expanded on those. It was a couple hundred pages. This bill was almost 1,000 pages. Just to give you an example of how much bigger this is. It also included things that have nothing to do with tax. So there's a ton of stuff in this bill. The whole point of this was one bill to legislate and reshape the current tax code along with other government budgets and government priorities. So it's a lot of stuff in there. We're only going to concentrate on the tax specific stuff and the things that I think are most relevant to most people. So big stuff that we're going to look at is increased bonus depreciation, estate exemption changes. This was kind of a surprise at the end of the bill. Increased and expanded tax credits and increased deductions. And there's going to be a few examples of each of those. Some of the provisions take effect either soon at the end of this year or they change at the end of this year, beginning of next year. Some take effect retroactively and to previous years even, and retroactive to the beginning of 2025. So we have kind of a limited window to plan and implement stuff for this year specifically for your 2025 tax year. And delaying could definitely miss some opportunities for this year. You can always catch up and do some stuff in 2026 as well and going forward with these provisions, but it's important to not miss as much as you can. There's no reason to leave money on the table ever. All right, so first we'll go over the specifics of them. There was an increase to estate tax exemptions. 100% bonus depreciation is back. The child tax credit and the employer provided child care credit was expanded. Changes to energy credits, not particularly good changes for most people. That's why we'll address those as well. And some changes to existing deductions. So first one, this is for anybody who's lucky enough to have more than 13 million plus in an estate. at some point when they're estate planning. And they've done two big things here. One is that they've jumped up the overall estate tax exemption by 1.4 million. Now that's just for federal. A lot of times, most states have some sort of piggyback rules that will also increase their exemption amounts. So depending on which state you live in, those could have increased as well with this bill, depending. And then after 2027, so this is going to be the limit for 25 and 26. After 2027, the limit's going to be tied to inflation, which is also a positive thing. That doesn't mean it won't go up even more at some points. They can always make another bill that increases the exemption amount later. But in general, it went from 13.6 to 15 million, and then if you're married filing jointly, double those totals, 27.2 to 30 million. And basically what this means is that higher exemption means less overall state tax, or the more fun name for it, which is death tax, that you'll end up paying if you do have that kind of wealth in your estate. This is the super exciting one for almost all businesses. Any business that's buying any sort of equipment ever, the bonus depreciation was down to 20% at the start of this year, and this increases it back up to 100%. Bonus depreciation is roughly 25 years old as far as a tax deduction, and it's varied between 10% to all the way up to 100%. Kind of seesaws and goes up and down depending on what bill and how long it's been. So this particular year, it was supposed to go down to 20% and then be eliminated entirely in 2026. So it jumps back up to 100%, and it is also now made permanent, so that the seesaw doesn't continue to happen. Not to say that it can't be appealed or repealed at some point, but currently it's going to stick at 100% until further notice. This is kind of a weird one because it's retroactive to January 20th, 2025. So if you were unfortunate enough to buy a piece of equipment on January 19th, you will get the 20% bonus depreciation. And if you had bought that one day later, it would be 100%. That's a unique to this particular bill. I don't think I've ever actually seen a retroactive date as specific. I believe that is Inauguration Day.
Real quick, James, and thank you for the questions. As they come up, put them in the chat and we will address them as we go. James, someone wrote in and said, can I write off a real estate investment property? And what about cost segregations?
Okay, so not directly. Bonus depreciation doesn't apply to real estate in general, but with the cost segregation, basically what a cost segregation does is it takes your real estate investment and it breaks it up into a whole bunch of different pieces. It breaks it up between land and depreciable useful lives of very specific items in that particular property. So say cabinetry or plumbing or whatever. And it will break up things that will be 20 years or less in a useful life or recovery period for the IRS, and those you can use bonus depreciation. So it's kind of a no and a yes. You can't write off the actual land, and if you don't do a cost segregation, you can't use bonus depreciation for it at all.
Awesome, thanks.
All right, a couple of tax credits were expanded. Child tax credits going to be increased from 2,000 to 2.2K. And then indexed to inflation between 2026 and 2032. It's important to mention too, when we talk about indexing, that most of our tax rates and standard deductions and quite a few different numbers that you see in your tax return are already indexed to inflation. So it's a nice little bonus that these types of credits are now also indexed to inflation because you get a slight increase every year. So that's important to note. Also, that there are limits. Most of the limits are based on budgetary reasons. That's all politics. Won't get into that, but that's why it'll have like it's capped for, or it's indexed for inflation between this year and that year, or it stops this year, and then the Senate and then the House of Representatives would have to go back and decide what they're going to do with it at that point as well, just like how this bill came about. There's an increased cap on the employer-provided child care credit. This is mostly for larger companies that offer child care to their employees on site. The percentage of it doesn't change. but the amount per year has been increased substantially, almost more than 3 times. And then this is for anybody who has a cafeteria plan, um, or an FSA. There's a couple names it goes by. The increased contribution limit for dependent care assistance goes from 5,000 to 10,500. So, I mean, overall, these can offset quite a bit of income. The child tax credit's definitely nice because that's a direct dollar for dollar difference in your tax bill. And dependent care assistance going up makes a lot of sense, being how expensive dependent care actually is. So the $5,000 cap was really not sufficient anymore at this point.
Just to make sure I clear up all those internet tax experts, just to confirm, because you are actually an expert, James, pets do not qualify as for the child tax credit.
No, no, not for the child tax credit. Though you could technically take a pet if they were a guard dog of some sort and you had a legitimate business and you had your dog there, that could be some sort of an expense, but that's more specific situations. I had a funny client at some point that tried to write off their dog as a security expense, and it was kind of I think it couldn't have been more than a 10-pound little kind of yipper dog. I'm not sure what kind of dog it was, but they were insistent that he was part of their security system at their office. And no, that was not a legitimate tax write-off. That didn't work. Okay, lots of changes on the energy credit stuff. So first, kind of the bad news is that the majority of them are going completely away by the end of this year. So the used EV credit and the new EV credit for buying an electric vehicle will stop on September 30th, 2025. So if you are or have been thinking about buying an electric car, definitely try to do it before September 30th, 2025. Otherwise, you will not get that credit. And that includes leases as well. Lease credits usually go to the dealer, and the dealer passes those savings on to you either in full or partially, but that will go away on October 1st. Home energy improvements, this is for stuff like insulation, new windows, heat pumps, energy efficient type stuff that you're adding to your house. That's going to expire at the end of the year. So same thing, it's not a huge credit, but $1,200, especially if you're already planning on doing something like this anyway. Try to take advantage of it before the end of the year so you get this little benefit as well. Um, Residential clean energy, that goes away as of the end of this year as well. And then new energy efficient homes, that expires halfway through next year. So just these are important changes because they didn't completely go away right away. But if you're planning on doing something, make sure you're hitting these deadlines. That's something I want to mention too. We very rarely encourage you to do something simply like if you were actually working with us simply to save on taxes. We try to intertwine what you've already got planned, what you already have going for you, to what we can find in the tax code that's able to help you out. It's never a perfect idea, at least, to just do something only for the tax credit. You still have to spend the money on that particular tax advantage asset or that investment anyway. So it's not like you're getting a net gain. You still have to go spend money to get any sort of a tax credit anywhere in the tax code. All right, next big one is the salt cap. This had quite a bit of news and debates on it, but it has gone from $10,000 to $40,000. It is phased out. It does start to phase out at $500,000 of income or above. Um, Even at that point, most taxpayers will still get the minimum of a $10,000 deduction. Now, this one is temporary. This only lasts until 2029. I think more because it's quite an expensive provision, specifically in states that have really high real estate tax, like say New York, Illinois, California. If I didn't mention your state and your real estate taxes suck, I'm sorry. But in general, that's what it was for. And this is a huge win for pretty much anybody that has a house, anybody that pays high state income taxes.
James, I did get a question of what does this include for the salt cap relief?
So it's state and local tax is what SALT stands for. So basically, any state income tax, any state real estate tax. So if you own a house and you live in Tennessee, then it's only going to be because there is no income tax in Tennessee, it's only going to be your property tax. If you live in California or New York, it's going to be your property tax and your state income tax and any other state or local taxes that you can come up with. So it's kind of a combined number. All right, this one's pretty big too. This is up until this year and for the past couple of years. Research and experimentation expenses, and I want to make sure we understand that there's a difference between this and the R&D tax credit. R&D tax credit is completely separate. That's why I'm calling it R&E and not R&D. So you were required before this year for the last couple of years to amortize any research and experimentation expenses over a 15-year period. So if you went out and spent, $45,000 to try to develop something new in your company, you weren't able to take that deduction right away. They've now changed this so that you can take everything immediately like it had been a few years ago. And you can also, I believe it was 2022 is the first year that you had to start the amortization. Now you can take it all at once, and if you're a small business, which is any business under $31 million in revenue a year, you can also retroactively amend your tax returns between 22 and 24 to take advantage of this as well for R&E expenses that you had already amortized, and you could potentially carry that forward and get a refund. So that's something nice. Oh, one thing is, I believe this is a change, is that it has to be the both internal and contract R&E have to be U.S. based for you to be able to do this. All right, key taxpayer highlights. This is kind of an everybody slide, business or not. There is a new senior bonus deduction. This is in addition to the standard deduction. This runs through 2025 to 2028. There's a phase out that starts at $75,000 in income or $150,000 for a married filing joint. These were kind of well publicized, the deduction for overtime pay and the deduction for tips, up to 12.5K and 25K respectively. There are some phase outs that start at 125 and 100K in income, and then 250 and 200 for married filing jointly. I do want to point out that this is a deduction at tax time. So at least for this year, nothing will actually be like this won't affect your actual paycheck. So if you're receiving overtime at your current W-2 job or you receive tips at your current job, it's going to be taxed the exact same way that it was before. This is only for income tax. It's not a deduction for Social Security or Medicare or payroll taxes or local taxes. Then in 2026, when you file your 2025 return, you'll have the opportunity to take this deduction up to those amounts. IRS will give out some guidance on what that looks like probably in October. So the 1040 will look a little bit different next year with these added things. And then they haven't really announced, we'll find this out in October as well. They haven't announced if they're going to change the W-4s to incorporate either an overtime pay and tips deduction automatically. Something else to point out is that despite what TikTokers might tell you on this one, there's no way to game this. There's no way to reduce your normal hourly income and claim everything as overtime because you maybe get a different rate for overtime. And there's no way to do it with tips either. It is only for people that normally receive tips. So like as an accountant, I can't suddenly decide that part of my wages are tips and be able to take that deduction. And even if I did get a tip, because I'm a profession that does not normally receive tips, the IRS guidance is definitely going to strike that down to make sure that people don't try to take advantage of this one if they're not supposed to. Same with the overtime one. I couldn't take my pay and say I want it to be paid minimum wage on my first 40 hours, and then I want it to be paid some insane wage on the next hour after that. That's considered overtime. So something good to know. Another big new one is interest deduction for a new car, up to $10,000 per year. If you go buy that EV before September 30th and you finance it, you can deduct as an above the line deduction, similar to the standard deduction, up to $10,000 in a given year of just the interest portion of what you're financing. That's a pretty new concept as well. Most businesses are able to write off interest. I believe besides mortgage interest, this is the first one outside of that in quite some time. I know back like 70s and pre to that, you could write off credit card interest at some point and all kinds of other stuff. But this is the first time probably in 40 years outside of mortgage interest and business interest that you can write off any sort of an interest on your tax return.
I believe you just gave, I had two people ask, can you give an example of the deduction for a new car? I think you just walked us through that. James, this is a constant conversation that you and I have with people we speak to, is how to utilize your personal vehicle for business purposes in a tax efficient way. We could probably have an entire webinar on that, and if you lined up 100 CPAs, you might get 100 different answers. But if you don't mind touching on that, because I think everyone would find some value in there.
Yeah. So the biggest key to that particular question, because we do get that a lot, I get that constantly, is that you do actually have to use it for business. There's the biggest myth in what we call FinTalk right there, is that anybody can buy a car, and if they have a business, you can write off mileage or you can write off the whole car. It's simply not true. It is based specifically on business usage, and there are all kinds of rules to how big the car can be, how much it can weigh, how much you use it for your personal use. If it's a legitimate actual business, not just, you charge your neighbor $100 so that you can fill out a Schedule C. There's no way to game that one either, and there are a ton of rules. But the basics of it is, if you have a business and you use a car for that business, then you can write off at the very least a portion of the depreciation for the car as well as expenses. There's some options on whether you can do direct write off of actual expenses or keep track of mileage and get the standard mileage rate. There's all kinds of different rules, like I said, but the main key is that you do have to use it for business, and it has to be a business that is conducive to using a car. So again, if I'm an at-home tax preparer and I never visit my clients ever, and I work from home, there is no basis for me to be able to have a business car, not at least to be able to write it off or have it in the name of the company. If I'm a traveling salesperson, I don't know if that's still a thing anymore. Is that still a thing now?
Still a thing.
Um, if you're a traveling salesperson, you're driving, 1,000 miles a week. That's a perfect example of where a business car and that deduction would be completely legitimate. But you definitely have to. There are gray areas, but not as much as people would like in that particular subject. If you don't use the car for business, or you shouldn't be using the car for business, you can't take the deduction. The other thing is we run into issues with what car you buy. It's one thing to go buy a Honda Accord, or a $30,000-$45,000 car. You cannot justify, on the other hand, in the majority of cases, buying a 300,000 Bugatti. That's not going to work in almost any case. If you're a salesperson and you're selling luxury homes, that might be something we can make an argument for. But if you're just a normal traveling salesperson and you're selling, I don't know, solar panel installations, your Lamborghini, your Bugatti, that's not going to work as a write-off. They're going to disallow that because it's not a necessary business expense.
Awesome. Thanks, James.
All right, so a couple things that everybody should do as they're getting prepped, even if you don't use us, as they're getting prepped for the rest of the year and going into the new year and tax filing season, is asking your current CPA, if you have one, on how these effects or how these new changes are going to specifically affect you. Um, they're going to know your situation, or if we are working for you, we're going to learn your situation, and we're going to be able to tell you exactly how these are going to affect you personally and how you can take advantage of them right now. And that's why the next one is on the timing tip. Don't wait until quarter 4. In fact, don't wait until the end of quarter 3. Don't wait until the end of the month. There's some stuff that's going to take some time. If you're looking to buy a $300,000 piece of equipment by the end of the year, there's financing, there's delivery, there's installation, there's some stuff that you have to take into account, and specific rules on timing on whether this will count for this year or next. So you don't want to wait until the last minute.
All right. Before we wrap up today, I did have a few, or at least one question that we want to circle back to. While I address this, if you have any last second questions, anything you want to go back to on any of these topics, please put them in the chat right now. James, I just got a question about referencing back to the SALT cap. Can you elaborate more on this and how it helps individuals' tax situations? It appears this doesn't limit my deduction, but where am I able to use the deduction so that it benefits my tax situation?
Okay, so you do have to. It definitely doesn't benefit everyone. If you itemize your taxes, then you could that's where the SALT limit even kicks in. If you're only taking the standard deduction and you don't have enough money to go past the standard deduction or enough deductions to go past the standard deduction and itemize, then this isn't really going to affect you at all. Now, that being said, having an increased amount of possibility of cap to 40,000 might help you get past that standard deduction amount. Does that answer that? Does that make sense? So if you itemize, you can take advantage of it. This is going to affect you. If you don't itemize, then the SALT cap doesn't do anything for you.
Um, I did get a question about the Astros here, but we'll skip that.
Okay, that's just cold.
Uh, Awesome. That just brings us to the end today. Everyone, thank you so much for joining us. If you like to take next steps, we'd love to connect with you. Our information's on the screen here. So whether it's a specific question about the One Big Beautiful Bill or guidance on proactive tax planning, or simply just have a few questions, we're here to help. You can reach out to me directly. My contact information is on the screen. You can use that link on the bottom left to book time, as well as James or anyone else on the team here at Tavola. We are very good resources for all your accounting and tax needs. A big thank you to James for breaking down OB3 today, and to each of you for spending the time with us. We truly appreciate it and look forward to helping you protect more of what you earned while building long-term wealth strategically. This session was recorded. It will be available on our YouTube channel, and we'll email that out to you directly in the next few days.